Take a look back at the roaring stock surge of the 1920s, the frenzy of the early 2000s housing market, or the post-lockdown market highs of 2020. During these peaks of economic euphoria, the societal consensus is always identical. We have finally figured out the math. Risk is a thing of the past, and asset prices will climb endlessly. Looking at this timeline of global market data shatters that illusion. From the Roman banking collapse in 33 AD to the Dutch tulip bust in 1637, right up to our modern era, market crashing is a persistent mathematical reality. We have advanced algorithmic trading, global institutions, and highly educated central banks, yet we walk straight into the exact same trap, generation after generation. We repeat these disasters because every economic collapse, regardless of the century or the technology, runs on identical mechanics, a predictable three-stage life cycle. Stage 1 is the buildup. Extended periods of stability and growth make investors careless. Confidence swells into unchecked greed, and individuals begin taking extreme risks. Take the early 2000s. Lenders aggressively approved massive mortgages for subprime borrowers who had low incomes and poor credit histories, assuming rising housing values would cover any potential defaults. This illustrates leverage, borrowing heavily to buy assets. When prices drop, it multiplies losses, leaving a fraction of real money supporting a precarious debt tower. Banks chopped these risky loans into mortgage-backed securities, rated them safe, and sold them worldwide. What starts as a stable economy becomes a highly pressurized house of cards. The entire structure relies entirely on the impossible assumption of endless growth. Then comes stage 2, the catalyst. An unpredictable shock hits the system, exposing the fragile math underneath and shattering the illusion of safety. In October 1929, that shock was Wall Street realizing stocks were wildly overvalued. The trading floor erupted in panic, collapsing the market in a matter of hours on Black Tuesday. In 1973, the shock came from outside the financial sector. OPEC deployed a silent weapon by cutting off the supply of oil to Western nations, quadrupling fuel prices overnight and freezing industrial growth. And in 2020, a mysterious virus spreading from Wuhan triggered rapid global lockdowns. Borders closed, supply chains froze, and shutters fell on entire economies within weeks. The specific nature of the trigger rarely matters. What matters is the velocity of the shock and its immediate ability to puncture the vulnerabilities built up over the previous decade. That puncture leads directly to stage 3, contagion. A localized panic bleeds into the interconnected nervous system of global banking, freezing credit and halting international trade. In 2008, as U.S. housing prices dipped, mortgage defaults surged. Massive investment banks holding those mortgage-backed securities couldn't renew their short-term funding, triggering the sudden collapse of giants like Lehman Brothers. When the credit lines disappear on Wall Street, the real economy suffocates. Businesses cannot secure funding for payroll, operations shut down, and jobs vanish. During the Great Depression, the unemployment rate hit a staggering 25%. Men in crisp suits found themselves standing in block-long lines just to get a single meal. Decades later, the 2008 meltdown left millions of families staring at foreclosed homes and entirely evaporated life savings. Contagion proves that no sector exists in a vacuum. A miscalculation at the highest levels of global finance always cascades down to devastate the ordinary citizen. At the peak of a contagion, trust vanishes entirely. Everyone tries to sell, no one is willing to buy, and the free market is completely incapable of saving itself. To break the cycle, massive government intervention is required. Central banks step in, slashing interest rates to zero to force money back into the system and resuscitate economic activity. In the 1930s, this took the form of FDR's New Deal, a bold deployment of public works and strict financial reforms to catch a falling economy. In 2008, the U.S. government poured $700 billion into failing banks through the TARP program. 12 years later, Congress passed the $2 trillion CARES Act just to keep citizens and businesses afloat during lockdowns. When the math finally breaks, the state is the only entity with a balance sheet large enough to absorb the catastrophic costs of all that unchecked optimism. Is it possible to survive a global meltdown? During the 2008 financial crisis, Australia served as a massive economic control group. While Western economies cratered, Australia avoided the worst recession since the 1930s. They maintained strict domestic banking regulations, had virtually zero exposure to toxic U.S. subprime loans, and leaned heavily on physical exports to a growing Asian market. Their survival proves that while human greed is a constant, rigorous regulatory guardrails can successfully stop a contagion from destroying a nation. But history shows that memories fade. Regulations are relaxed in the name of growth, risk returns to the market, and the build-up cycle quietly resets. The question isn't whether the economy will collapse again, it is simply where the next catalyst will strike, and whether our financial firewalls will be strong enough to survive it.